Hey everyone, happy Friday. Today on the final bar, we'll wrap this week. We'll look at the volatility we've experienced, although the volatility technically coming down a bit. We talked about the VIX on the show yesterday, along with some other sentiment indicators. How did the week actually net out on this choppy flat Friday? S&P closing the week just above around 3,900. Overall, what's the trend? And what is one key group where we should look for strength? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, David Keller. I'm the chief market strategist here at StockCharts.com. Normally from Redmond, Washington this week, on location in Naples, Florida, enjoying a thunderstorm which just knocked out power to my hotel about 3 minutes ago. So we're doing our best to get the show to you today. We got a lot to talk about when we review this week and sort of wrap up all the events that we've been experiencing. Choppy experience today with the S&P sort of rotating around that 3,900 level, down a bit at the open, up a bit at times during the day, at the end netting out to essentially an unchanged from Thursday's close. Now, Thursday's when you had a pretty nice move to the upside. So the market taking a bit of a breather here at the end of this shortened holiday week, setting the stage for what's to come next week. We're going to look at some of the indicators in our Mindful Investor Live chart list. We'll talk about price, focusing on the S&P 500 and a couple other assets. We'll talk about the breadth conditions, and that will be a companion to what we talked about yesterday, which was looking at sentiment, still fairly bearish. And as a quick preview, the breadth overall, long-term negative, short-term a little positive. We're seeing a bit of a bounce here, but we'll look at the evidence here together. Next week, we have some great content lined up for you. On the 12th, on Tuesday, we have a special episode on ratio analysis. I feature a lot of relative strength analysis on this show, particularly looking at ratios, things like offense versus defense, looking at different sectors and themes. And that's a show devoted to that form of analysis. On Wednesday, the 13th, Sam Burns from Mill Street Research in Boston. On Thursday, the 13th, Carolyn Borodin, a Fibonacci expert, who will share with us some key levels to pay attention to on the S&P 500. Let us continue on today's show. Let's wrap this week. We like to do it in a couple phases. First, we'll check in on what happened today. We'll focus on some of the big picture trends in the over the last week, and then focus on the Mindful Investor Live chart list. First, however, let's go to a poll. Recently, we asked you on our social media accounts, so make sure you follow us on Twitter, subscribe to our channel on YouTube. And we also have a poll running on our live stream at StockCharts.com. We asked you, what's your probability of the S&P 500 closing above 5,000 on the last trading day of 2022? It's about, 5 months out from where we're at right now. Currently, the S&P nowhere near 5,000. We're just below 4,000, right around 3,900. What was the answer? 60% of you said below 30%. Essentially, a very minimal chance the S&P would be able to regain all-time highs at the end of the year. 30 to 50% is about 27% as a response. So what that means is 87%, about 9 in 10 of you say there's a less than 50% chance that we close above 5,000. I did not vote on this poll. I probably put it below 30%. The reason why I asked this question, number one, is just to get a sense of where you all are at. And I get the overall skepticism that we would regain all-time highs. And I think that skepticism is well-founded based on the analytical techniques that we feature on the show. But it's also to show you that thinking about the market in terms of levels is never about absolutes. We often simplify and say, are you bullish or bearish, right? Is it thumbs up or thumbs down? Are we going to go above this level or not? And what you have to remember is it's all about probabilities. Investors, institutional investors, think of it in terms of probability. So the phrasing of that question is how I would encourage you to phrase your own thinking about the financial markets and technical indicators in general. Let's continue to wrap this week. Let's talk about just briefly the market today and what sort of information we can gather. As I mentioned, the S&P, the NASDAQ, essentially unchanged. They chop around quite a bit, but finishing right around at the zero level. The VIX off a bit and back below 25. Now, this is interesting because the previous brief rally that we saw, I think it was in May, the VIX got right down to around 24. That was the peak before the next leg down. That was the bottom in the VIX before the VIX rotated higher. So we're getting very, very close to where the VIX was during the last sort of short-term rally. Other asset classes very quickly. Interest rates pushed higher yesterday and continue to go higher today with 10-year yields now up to around 3.1%. This is after being well below 3% here in recent weeks. Bond prices, of course, coming down related to higher yields. The dollar index was essentially changed from Thursday. Gold chopped around quite a bit, and an interesting pattern in the last 2 days, a big acceleration to the upside for the GLD in the first hour of trading, hour and a half of trading on both days, but finishing more in a position of weakness. So gold essentially unchanged from yesterday, even though earlier in the day it was up quite a bit, up to around 163.20 on the GLD. Sort of mixed results overall for the commodity space as a whole. Cryptocurrencies are seeing some strength yesterday, but more choppiness today, with Bitcoin around 21,800 and Ether around 1240. Let us go to the wrap the week chart. So this is where we're just looking at the last 5 trading days. We're in a shortened holiday week like we see today. We'll back it up to 4 days. Clear the 4th of July holiday off on Monday. So here's what happened since last Friday to where we're at on this Friday. In black, that is the S&P 500, finishing the week up about 2%. That's not a bad week. And you have to remember, a lot of the weeks that we've been looking at in 2022 have been fairly difficult, right? Fairly negative. This is more of a net positive week, which is important to note. The dollar index, almost identical return to the S&P, also up just under 2%. Everything else here outperformed, as I'm about to share with you. Small caps, this is the Russell 2000 ETF up 2.4%, the NASDAQ 100 up 4.7%, and in blue, Bitcoin, the big winner, up 13.3%. Now, you have to remember the problem with the charts of Bitcoin and Ethereum and other of the common coins that we track is that they're down so much year to date. So nice week, but you still have not chipped away much on the losses, paper losses that most investors would have if you bought at the beginning of the year and have just held on to it from that point on. Everything else I'll share with you now has underperformed the S&P for the week. In this one right here is emerging markets up 0.6%. In red, we have bond prices down 2.9%. Gold and in brown, crude oil prices, both down about 3.6 to 3.8%. So it was certainly sort of Bitcoin and technology, sort of the more risk-on area of the market, outperforming dramatically the commodity space. And that's a bit of a mean reversion, or a very big mean reversion from what we've seen year to date. Year to date, it's been crude oil and commodities super strong, technology, Bitcoin, crypto is super weak. Bit of a mean reversion this week with that narrative flipped on its head. Let's continue on our Wrap the Week segment, looking at the Mindful Investor Live chart list. Now, this is a set of charts that I keep updated on the StockCharts platform. If you've not followed my work or followed the show before, if you go to the Articles tab, by the way, I'll show this to you very quickly. If you click on all StockCharts blogs, go to my blog, which is called The Mindful Investor. I just posted an article a couple hours ago talking about what happens if the FANGs break out. And I'll share with you the chart of the FANG stocks that I think is important to follow. It's in a consolidation pattern, a symmetrical triangle pattern. It'll be very interesting to see which way that breaks. We're testing the upper round of that, enter that boundary as this week ends. So make sure you check out my blog for that most recent article. Has a chart in there to pay attention to. And then when you click on this live chart list button, it's going to take you to the list of charts that we're reviewing right now. We start with the market trend on the S&P 500. I use weekly data and I look at 3 different time frames: long-term, medium-term, short-term. And this is essentially following my general way of thinking about the market environment. Long-term is a year plus, medium-term is a couple weeks to a couple months, and short-term is a couple days to a couple weeks. And that's the general way that I tend to think about things. All 3 of these had been negative as of last Friday's close. I update them every Friday at the close. I didn't have a chance to change this label of my short-term model, just barely, slightly, narrowly turned back to a bullish call. I don't have a neutral rating on these indicators, by the way. They're binary. It's just bullish or bearish. And I did that for simplicity so I could look at bunches of charts using this set of moving average based indicators and make a quick assessment about what was working and what was not. If I did have a neutral rating, the short-term model would certainly be neutral, but at this point, it is now just barely tipped positive. So the indicator for me stands as long-term bearish, medium-term bearish, short-term bullish, just about how the market feels as I think subjectively about what I've seen. When we look at a daily chart of the S&P 500, you can see now with the bounce that we saw through the course of this shortened holiday week, this is a nice recovery from the drop we had last week, right? We had sort of the gap higher, the big up day, sort of a pause, and then the big down day with a nice downside reversal quickly being alleviated, and this week being all about short-term strength. So every one of the 4 trading days this week closing higher than the open, closing sort of further in an upside direction. We had a bit of a, sort of a sideways move today at the end of the day, but overall, you're seeing some short-term optimism. The last 5 candles are all open candles where the close is above the open. That's encouraging. Here's a thing, though. Has it really changed the picture of the market? I would argue not yet, right? The S&P is still below its 50-day moving average. The S&P is still nowhere near the previous swing high, which if we would regain this one, which is around 39.50, and regain the 50-day, I think that makes it a nice short-term uptrend. I think I would have to be looking at further upside targets, and the next one would absolutely be 41.50 to 4,200. That would retest the highs from the end of May, and also be a key price level we paid attention to, a Fibonacci level we've reviewed before, around 4,200. But first things first, right? You need to see the follow through next week. This is the bounce sort of retracing to the previous highs. Do we get above there? The other thing I would need to see, besides getting above the previous swing high, getting above the 50-day, would be the RSI getting more into the positive range. In bearish phases, the RSI's range tends to get pushed down in a big way. So on rallies, we rarely gain 60 or get briefly above it before rotating lower. On downtrends, we often become oversold. That's kind of the range that the RSI has been in for the last 6 months or so, really since the end of last year. So overall, you need to see a rotation higher to really get excited about material gains further from what we've seen so far. Until I've seen that, until I've seen the evidence that the market would provide by regaining those previous highs, I have to think more weaker rather than stronger in terms of the overall conditions. The breadth conditions we'll talk about here briefly. The S&P on a closing basis, again, you can see this sort of bounce higher and now retesting the previous swing high at a pivotal moment going into next week. So I think it's an important chart to watch, but also pay attention to the breadth conditions. All of the advanced decline lines that we follow made a new low in June, and all 4 of those now have rotated higher. Only one of them is really testing the 50-day moving average. That's this one here, the small cap AD line. The rest of these are still sort of behind there. We'll see as we update the closing data going into the weekend if we sort of trigger any sort of change to that thesis that I've just said. But in my opinion, as long as we remain below the 50-day moving averages here, the trend is still by default down. They're still coming off of new lows. And again, what you want to look for is when these breadth lines try to make a new low and don't quite do it. I don't know if I've seen enough to think of that pattern as being changed yet. So I'm still color coding those all red, thinking more negative. Key moving averages, also important to watch when you're looking at breadth and looking at the individual names that comprise the S&P 500. 23% of the S&P members are above their 200-day. That means 76% below their 200-day. That's a lot of names. And about 28%, about 3 out of 10 above their 50-day moving average. So you've seen a nice bounce higher from single digits up to 30%. That means about a quarter of the S&P over the last couple of weeks has gone above the 50-day moving average. The S&P itself has not done it yet. So you need to see these breadth lines continue to appreciate to be more optimistic. You've started to see less and less new lows. That's because everything's kind of bouncing higher this week. So an evaporation of new lows, we really haven't seen any new highs. And you've seen some stocks start to break out, particularly like in healthcare. You're seeing new 52-week highs. Something like Eli Lilly comes to mind as an example of that type of chart, but it's not enough to even register on this histogram here, right? So you need to see more stocks that are able to make new highs to confirm that there's a rotation positive in breadth. We've not seen enough yet, even with the bounce this week, not quite enough positive breadth to trigger a positive signal. Let's take a quick commercial break. We'll be back with my next segment, Power Up. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. We appreciate you joining us every weekday after the close as we break down the activity in the markets using the power of stock charts, using the technical toolkit, which I would argue is ideal for a bear market phase. The charts will tell you when the trend is down. The charts will tell you when the market's in transition, and the charts will absolutely tell you when there's a recovery in play. This is why it's such a crucial time to be following the charts and hopefully following this show into next week and beyond. A couple of quick announcements before we get to my next segment. We feature questions on the show a couple times a week. Later in today's show, we'll do a mailbag segment, answer some of your recent questions. They all come from people like you sending in questions when you're struggling with analyzing and interpreting charts in your StockCharts account. So send us an email, thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. We're on YouTube. Put a comment below the video you're watching on our StockCharts channel. We'll gather all your questions. Hope to answer one of yours live on the air next week in our mailbag segments. Also go to StockChartsTV.com. That's our on-demand platform. There's so much great content, and we're working as a team to really think about how we can help educate and empower our viewers during this bear market phase, this volatile, uncertain phase. So a lot of great content, all for free, every trading day at StockChartsTV.com. Or on your mobile device, just search for StockCharts TV on demand. Our next segment is called Power Up. What we like to do once a week is just spend a few moments highlighting a part of the StockCharts platform you may not know about or probably don't use nearly as much as you should. On yesterday's show, we did a deep dive, I think it was yesterday, on the financial sector, and we dug into that sector. We used the industry summary report to break down different industry groups by sector. I now want to share with you what I call the sector summary report. These two reports that we talked about yesterday with the industry summary and today with the sector summary is a really beautifully designed set of functionality on the StockCharts platform that helps you understand that relationship between the broad market environment, between the 11 S&P sectors that comprise that major index, the individual industry groups that make up those sectors, and then the stocks that make up the industry groups. This sector summary page is the way that you connect all the way from the top level to the bottom level and understand the structure of the equity markets here in the US. So when you bring up the sector summary page, it's going to default to the S&P sectors. It's going to list them out in order. Now, you can sort this list however you want. So when you sort by the scooter rankings, what this is doing is taking these 11 sector ETFs along with all the other ETFs we have in our universe and putting them in trend order from strongest to weakness. So what are the strongest trends right now? Energy, number one, healthcare, number two, utilities, number three. At the bottom, the weakest, probably what you'd guess, communication services, consumer discretionary, materials. What you can then do, let's take healthcare as an example. You can click on that sector, and then you get the 5 industry groups that make up that sector. So the same thing, we can put that in scooter ranked order, which means from strongest positive trend, I guess I would say, to the strongest weakest or strongest negative trend. On the top, we can see the pharmaceuticals group and healthcare providers group, both scoring very well on our scooter ranking model, both in the top 5% of industry groups. On the bottom, you have medical equipment and medical supplies scoring a little less attractive. From there, you can click on biotech, and you can look at the individual names that comprise that group. So you can see it's sorted on percent change. Now, this is biotech, which tends to be a pretty noisy group. So you can see a number of these names are up double digits today. You can obviously click on one of these to dig into the chart and learn a little bit more about them. It's currently showing a lot of small cap stocks that are up a lot. That's usually what happens in biotech. It's dominated by small caps that are usually up in a pretty big way. If you go down to things like mid caps or small caps, we can start, or mid caps or large caps, you can start to see some of the names that you may be a little more familiar with. You can also sort the entire list by the scooter ranking. This will allow you to find some of the better scoring charts out there and make sure you look at the market cap column to get a sense of where these things track. From there, it's very easy to find in a leading sector, in a leading industry, in a leading group, which are the stocks that are breaking out and scoring very well. Here's how I found Vertex breaking to new 52-week high, closing high today. That is our sector summary tool. Again, you can find it on our charts and tools tab. It is a brilliant function to help you understand the different sectors and the groups that comprise those sectors. We need to move on today and go to the Final Bar mailbag. As a reminder, all of our questions come from you guys. Our email is thefinalbar@stockcharts.com. And let's get to question number 1. I watch and track $NYAD, $NYA, and this other one, ADLINENYC. NYAD has lots of bond funds. The latter two should be common stock symbols, and yet at times they track and look very different on a chart. Why is that? And then he went on to say, I like $NYA because of the historical data available, but it's annoying they all look different in performance when they should be tracking common stocks. What are your thoughts? So I took a question, which I very much appreciate. I created this chart just to help you understand the different tickers that you're using. So $NYAD actually looks like this. If you look at the raw data, it is a daily advanced decline rating. So it's literally showing you every day advancers minus decliners. So as you can see, it sort of chops around the zero level because some days are up, some days are down. And as a result, it's essentially an oscillator. It's super, super choppy, helpful for one particular day to see whether advancers or decliners are outperforming or doing, they're more of one than the other, but it doesn't really help you understand the trend. So we have a type of chart called the cumulative chart that allows you to take a noisy indicator like that and look at a cumulative value. So this is the NYAD, which is basically all the issues on the New York Stock Exchange, advancers, decliners, all together, showing you the data over time. Now, we also do that automatically in our standalone indicator, exclamation point ADLINENYA, and the A stands for all. So this is everything. But as you imply in your question, that includes some closed-end funds, some ETFs that are listed on the New York Stock Exchange. It's not just common stocks. So we have a separate index, exclamation point ADLINENYC, and the C stands for common stock only. Now, if you look at these three series, you can see that the daily raw data in a cumulative format and the all listings on the New York Stock Exchange index that I shared with you, these two lines are identical because we match them up every day to make sure that our intraday data, our end of day data is matching up with our own indexes. So these two are basically and exactly identical. They absolutely should be. Exclamation point ADLINENYC is common stocks only. Now, in general, these will move the same because most of the listings on the NYSE are common stocks, but you'll see at turning points, sometimes the raw AD line will make a new high. The common stock only will make a lower high. So there are some differences in the calculations, even though over the last couple of years, you can see they're very, very similar. But at turning points, you will find one might make a new high and the other one won't. I tend to use the common stock only in my work because I'm not as interested in things like the closed-end funds, the bond funds, not as meaningful to me. Now, you also mentioned in your question, $NYA. That's actually not looking at advanced decline data. That is actually the NYSE composite index. So that is an index, just like the S&P 500. But it's looking at a broader universe, all a couple thousand names. I don't even know exactly how many are on there. All of the common stocks listed on the New York Stock Exchange in one index. So it's like the S&P with more members. That's what you're looking at here. So these series will look a little different because this is actually looking at price data. This is looking at breadth data, but look at how similar they move. The correlations are actually very high because it makes sense. When the market moves higher, more stocks tend to gain than lose. And that's why those data points all go together. So looking at $NYA for the price, absolutely fine. I would look at NYC, this indicator here, to look at breadth indicators. And thanks so much for your question. Next question, if you had 100% cash at the moment, would you not deploy that cash in equities until the charts of equities generally reversed into a clear uptrend? You've been saying consistently that we are in a downtrend. Some analysts say it's right to cost average down at these levels. That's a really thoughtful question, and I totally get your point. I tend to talk about things in terms of trend. I try not to phrase anything like you should buy here, you should sell here, you should take on this position, because that is not my place as an independent market observer on a show like this. And we have disclaimers that make that clear. Our job is to help you make better decisions, not tell you what to do with your capital. It's something we want you to be able to do more effectively by using the toolkits that we feature on the show. Having said that, it all depends on your runway. So, in retirement accounts that I'm managing for my own account, I have equity positions that I've been taking on recently because I'm okay with the fact that the market could go lower another 5%, 10%, even 20%, because with a long enough runway, hopefully until I retire, I'm pretty confident that 5 to 10 years down the road, those assets are going to be trading at a higher level than they are now. I may be wrong, but I think that's a pretty decent bet based on equity market history. So if you are playing for the next 5 minutes or the next 5 weeks or the next 5 years or the next 5 decades, the way that you would deploy cash in this environment could be very different. And I would say, again, as long as your runway is long enough, buying things like Bitcoin, like cannabis stocks, like the S&P, things that you think overall will appreciate, and you're buying in after things have been down so much. I think that makes a ton of sense overall, and that's why I've done so in my own accounts. But again, it very much depends on your time frame. That's why I don't make those sorts of comments generally, because all of our time frames are a little different. Next question. Hi, Dave. Is there a way to scan for stocks that are within a certain percent of their 52-week high? For example, within 5% of the 52-week high. I've been having trouble with the script. And the answer is yes. And I created it for you. It's actually not too difficult, but you just have to know the syntax of it. Using our scanning engine, the line you want is this one right here, which I'm highlighting. And today's high is greater than yesterday's max. And then the arguments under that one are the last 260 days and high. So basically saying the last 260 high prices, what was yesterday's highest value of those last 260 observations? And then I'm saying 95% from it. So I'm basically saying within 5% of the today's high is within 5% of that all-time high, or that 52-week high. You can customize the look back period. So I often look at 3-month highs. So I'll do like a 65 or 63 for that value. You can go from 5% to 2% or up to 10% just by changing that decimal that you have there. But that is the way you can do it. The way that I find things like this, if I'm struggling up, by the way, the little magnifying glass in the upper right, just type sample scans. You will get to our support articles, and this one right at the top has a bunch of things like this, common things we get people asking like this. The syntax, you literally can copy and paste this text right into the scan engine, and you're off and running. That's it for the mailbag. Listen, thank you guys all so much for sending in those great questions. We so appreciate it. Keep them coming, but we need to wrap today's show. We've got to go to the 3 and 3. Here are 3 charts in just under 3 minutes that tell the story of this market environment. Here is chart number 1. This is the S&P 500 breadth by cap tiers. In our Wrap the Week segment, we were talking about some of the overall trends and conditions. And one of the things that we talked about was the trend lower in breadth. And I think the way that you can define that is using the cumulative advanced decline lines. One of the mailbag questions we had was digging into one of those, and that's the top series that I'm showing here in red. That's that exclamation point ADLINENYC. That's this one that I look at, and it's the main one that I would follow. But I also look at large cap, mid cap, and small cap to see if we get any discrepancies, because a lot of times at turning points, you'll see some of them make new highs and other ones do not. All 4 of these made a new low in June. I will be very much watching to see if one of 2 or both things happen. Do we regain the 50-day moving average on any of these, or do we make a new low for again, right? Because these indicators have essentially made new lows every month in 2022. Does that continue? That's why this is such an important chart to watch right now. Chart number 2, I just wanted to highlight sector returns over the last, really since the end of May, right? So if we start the clock at the end of May, we go from there. How have these different major sectors done? Well, the S&P is right at down 5.5% essentially since May 31st. Technology and utilities, look how interesting these are. Almost identical returns. So the S&P, the XLK, and the XLU, all about the same, down about 5.5% for the year. Look at these outliers, though. Energy is down almost 18% over that same period, and healthcare is only down 0.7%. So relative strength is so important. This type of chart where you're looking at returns from a particular time period, like the last 6 weeks, or a meaningful time period, like year to date, month to date, it can be really helpful to see what differentiation you can identify. Healthcare over energy has been a really decent bet. The charts have shown that, with energy stocks fairly weak, failing to hold support, healthcare stocks making new highs, which is pretty meaningful. Finally, let's finish this show and finish the week on a high note. I scanned for stocks making new 3-month highs today. This is one of the names that came up. About 2/3 to 3/4 of the name. It wasn't many, maybe 20 stocks today in a large cap universe, but 2/3 to 3/4 of them were all in this same sector, which is healthcare. Waters Corp is a medical equipment name. There are a lot of medical supplies, even some pharma in there, regaining the 200-day moving average this week, regaining a new price swing high today. Not a bad return with the RSI moving into the positive. Let's watch to see if further gains materialize going into next week. Folks, that is a wrap for this show and a wrap for this week on StockCharts TV's The Final Bar. All of our previous episodes at StockChartsTV.com. As a reminder, we have a lot of great content for you every weekday, every trading day for sure. All of those episodes are on our on-demand platform, also our YouTube channel. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great weekend. We'll see you on Monday.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.